What's going on, guys? Welcome back to another new video on this channel. In today's video, we're going to look at the top 5 US biotechnology companies. Pharmaceutical and biotechnology companies have lagged slightly behind the average market in the first 5 months of this current year. Shares are up more than 6% in the US compared to 9.6% for the US S&P 500 index. According to the Financial Magazine, this creates opportunities because the pharmaceutical sector is relatively cheap and the long-term growth prospects are excellent. We therefore bring you a selection of our favorite 5 pharmaceutical stocks. And just so you know, the selection was arrived at by looking at analysts' average long-term earnings expectations and price-to-earnings ratios. The two numbers were then compared to find the companies with the most favorable valuations. The stocks in the list show promising growth opportunities and therefore are good for investors. So, just before we get started, we have to clear the air on one thing here. Well, I know you're probably wondering whether Pfizer is on the list, right? To make it clear for you, Pfizer is just out of the selection. While this producer of one of the corona vaccines was still on the list in February, things seem gloomy for the future of Pfizer. This has to do with the poor long-term expectations for the corona vaccine. In a few years, the turnover will get a strong boost, but after that, the picture for turnover and profit will become less bright. Now, let's get on with the countdown. Be sure to subscribe to this channel and turn on notifications so you won't miss out on any of our latest episodes. Number 5. Amgen. Amgen, previously known as Applied Molecular Genetics, is a giant biotech company located in Thousand Oaks, California, and has been in existence for over 40 years. Amgen's price-to-earnings ratio is 14.9 based on earnings per share over the next 12 months. This is a relatively high valuation, but so are the expectations for earnings growths, standing at 10% last year. The main concern about this share is that there's increasing competition for blockbusters Otezla, which treats psoriasis, and Enbrel, which treats arthritis. However, analysts are positive about the experimental cancer drug Lumakras, which has already received quick approval. Analysts who consider this stock have given their thought, and indeed a majority are in support of buying or holding Amgen. So far, 13 analysts have given Amgen a buy recommendation, 13 more say hold, while 3 recommend selling. Amgen has a high potential for quicker growth in the coming decade, this considering that already investors who held the stock over the last decade have gained more than 400% with dividends included. And now, the recent move by the FDA to issue a highly accelerated approval to its new cancer drug Lumakras puts Amgen in a good position to increase its earnings at least for the next decade. With its share currently trading at slightly above $235 and projected to close this year at $256.3, there's no doubt that Amgen is a cheap stock that is likely to deliver accelerated growth in the future. Even though Amgen is not the only company developing a mutant KRAS protein inhibitor, it has attracted attention for becoming the first and only biopharma to earn approval for its KRAS inhibitor, Lumakras. Now, this puts Amgen ahead of its competitors, allowing it to take advantage of the existing high demand for KRAS inhibitors around the globe, and that translates to explosive revenues. And considering the current juicy 4% dividend yield for Amgen, this is indeed a stock to buy and hold. Number 4. Merck. According to analysts, Merck is expected to record an average growth of the earnings per share of 7.2% per year. Just like Amgen, Merck's figures for the first quarter were not great, probably due to corona, which just meant that Merck could sell less of its HPV vaccine. In principle, those sales should pick up again later this year. Now, for this share, the biggest long-term concern is whether there will be a successor to the sales of Keytruda, which treats cancer, and is responsible for sales of $3.9 billion in the first quarter of 2021. However, analysts remain positive about the stock, considering that cancer is a long-term medication disease and hence drug prescriptions will continue to bring good earnings in the future. Despite its share having traded low by 7% year-to-date, Merck remains a good dividend yield of 3.4%, which is generally higher compared to the pharmaceutical sectors in which it operates, that's standing at a yield of 2.4%. A look at Merck's dividend growth shows that its current annualized dividend of $2.6 is up 4.8% from last year. And important to note is that Merck has consistently increased its dividend 5 times on a year-over-year basis for an average annual increase of 8.5% for the last 5 years. We also get to realize that of the 22 analysts followed by FactSet, 17 rated the stock as overweight or worth buying, while the other 5 analysts put the stock on hold. Now, the strong dividend, solid revenue, and promising analysts' ranking make Merck a great stock to add to your investment portfolio. Valued at slightly above $187 billion, Merck's share is expected to close this year at $93.6. Number 3. Bristol Myers Squibb. With a market capitalization of $144.7 billion, Bristol Myers Squibb is a great biopharma with a favorable dividend yield of 3.2%. Its move to buy the successful Celgene in 2019 has accelerated its growth, making it an industry leader in cancer-fighting drugs, which accounts for about 66% of its accrued revenue. Although analysts have a slightly lower expectation for the profit developments of 5.7% per year, its share is a lot cheaper with a price-per-earning ratio of only 8.5%. Like the other companies on this list, Bristol has a promising pipeline, but will also face more competition for its current drugs in the coming years. It is estimated that the company's products, which are expected to account for a majority of its projected 2025 revenue, will face biosimilar and generic competition by 2030. Even though its blockbuster drug Opdivo is currently facing much competition with sales falling 3% in the first quarter, the company still has many new inventions awaiting approval. Still, its successful cancer drug Keytruda has continued to make investors happy by taking the place of Opdivo and exploding the company's sales. And if the awaited September FDA approval for the alternative use of Opdivo in the treatment of muscle-invasive urothelial carcinoma goes on successfully, we expect Bristol to get another win. Out of the 20 analysts following Bristol, 13 have a buy recommendation, while 7 analysts have put the stock on hold. Number 2. Abbvie. Abbvie is a biotech company that specializes in research-based pharmaceutical manufacturing. Its stock is one of the most highly traded in the pharmaceutical sector simply because it offers a reliable income investment with a track record of 49 consecutive years of dividend increases. Over the past, Abbvie's stock has risen by over 25%, with its revenue increasing by 51% year over year to hit $13 billion. The main concern for Abbvie is the criticism from the U.S. Congress of the high price the company is charging for Humira, one of the top-selling drugs in the world with first-quarter sales of $4.9 billion. It remains to be seen how that develops. However, as far as we know, the company looks forward to diversifying in the sector and finding more alternative drugs to Humira. Nevertheless, 17 of the 24 analysts have the share on buy, 6 analysts have a hold opinion, and 1 says underweight. Abbvie is valued at $198 billion and pays a generous dividend yield of 4.9%. Number 1. Alexion. And finally, we consider Alexion, which is a global biopharma specializing in developing drugs for treatments of rare diseases and devastating conditions. Even though Alexion makes it to this list, it should actually be disregarded because a takeover bid has been made by AstraZeneca towards the end of the third quarter, which has already caused the price to close to $175 per share offer. Already, its shareholders have voted for the acquisition by AstraZeneca, and now the acquisition is just pending additional regulatory clearances. As a leader in rare diseases for more than 25 years, Alexion managed to record a 13% increase in revenue in the first quarter to hit $1.64 billion compared to the same period in 2020. So to sum it up, Amgen, Merck, Bristol Myers Squibb, Abbvie, and Alexion are the top 5 U.S. biotechnology companies you can invest in right now. Although the biopharma market has performed badly in the first 5 months of this current year, the market seems to be picking up, and now it's trading at 6% above the S&P 500. While the pandemic may have restored the image of the biopharma industry, the focus for the future is shifting to stable drug makers that throw off reliable revenue year over year. Therefore, there's no doubt the future is bright for the above 5 U.S. biopharma. So what's your take on the top 5 U.S. biopharma companies? Let us know in the comments section below. And if you enjoyed watching this video, kindly give it a like and subscribe to our channel. Don't forget to turn on notifications for the latest updates whenever we post. Thank you for watching. Have a great day, and I'll see you in the next episode.